Oh, she's 10 minutes out.
Yeah.
Wow, it got real quiet. I know. I'm
Bracing for that gavel strike.
okay. The Committee on Insurance and Financial Services shall come to order. Mr. Clerk, will you please call the roll to establish a quorum?
Representatives Carter,
Present.
McFall,
Here.
Coleman,
Here.
Stone,
Here.
Breen, Rogers,
Here.
Scott,
Here.
Young,
Here.
Fitzgerald,
Here.
Grant,
Here.
Harris,
Here.
Markkinen,
Here.
Bazat,
Here.
Aragona,
Here.
Bruck,
Present.
Nair,
Here.
Smith.
Present.
Madam Chair, you have a quorum.
Thank you so much. And now we need a motion to adopt the minutes of October 5th, 2023 as printed. Representative Vice Minority Chair Harris moves to adopt the minutes as printed. Hearing no objections, the minutes are adopted as printed. First today is a vote for House Bill 4740, introduced by Representative Farhat, which we heard testimony on last week. I'm going to now read in the cards. Not wishing to speak and supports the bill, Christine Shearer, Michigan Association of Health Plans. Not wishing to speak and supports the bill, Tom Hickson, Michigan Catholic Conference. Hickson, oh, it's the email, okay? And not wishing to speak and supports the bill, Adam Carlson of the Michigan Health and Hospital Association. All right. Let's see. We need a motion to report House Bill 4740 with recommendations. Representative Rogers moves to report. Mr. Clerk, can you call the roll?
Representatives Carter,
Yes.
McFall,
Yes.
Coleman,
Yes.
Stone,
Yes.
Breen, Rogers,
Yes.
Scott,
Yes.
Young,
Yes.
Fitzgerald,
Yes.
Grant,
Yes.
Harris,
Pass.
Markkinen,
Pass.
Bazat,
Pass.
Aragona,
Pass.
Bruck,
Pass.
Nair,
Pass.
Smith.
No.
Madam Chair, you have 9 yeas, 1 nay, 6 passes.
Thank you. House Bill 4740 is reported with recommendation. Next on our agenda is a vote on House Bill 5057, introduced by Representative Stone, which we heard testimony on last week. We need a motion to report House Bill 5057 with recommendation. Representative Scott moves to report. Mr. Clerk, can you please call the roll?
Representatives Carter,
Yes.
McFall,
Yes.
Coleman,
Yes.
Stone,
Yes.
Breen, Rogers,
Yes.
Scott,
Yes.
Young,
Yes.
Fitzgerald,
Yes.
Grant,
Yes.
Harris,
Yes.
Markkinen,
Yes.
Bazat,
Yes.
Aragona,
Yes.
Bruck,
Yay.
Nair,
Yes.
and Smith.
Yes.
Madam Chair, you have 16 yeas, 0 nays, 0 pass.
Thank you. House Bill 5057 is reported with recommendation. Next up is a referral of House Bill 4842 to the Committee on Appropriations. Representative Young moves to refer House Bill 4842 to the Committee on Appropriations. Mr. Clerk, can you please call the roll?
Representatives Carter,
Yes.
McFall,
Yes.
Coleman,
Yes.
Stone,
Yes.
Breen, Rogers,
Yes.
Scott,
Yes.
Young,
Yes.
Fitzgerald,
Yes.
Grant,
Yes.
Harris,
Yes.
Markkinen,
Yes.
Bazat,
Yes.
Aragona,
Yes.
Bruck,
Yay.
Nair,
Yes.
Smith.
Yes.
Madam Chair, you have 16 yeas, 0 nays, 0 pass.
Thank you. House Bill 4842 is referred to the Committee on Appropriations. We are continuing our deep dive into the nuances of auto insurance preparation for hearings of auto no fault. According to an article written by the Michigan Auto Law Accident Attorneys, a staggering number of people driving without insurance, there is a staggering amount of people driving without insurance throughout our state. In some cities, like Detroit, it is estimated that over half of the drivers are driving without auto insurance. To further quote the accident attorneys, With an estimated million Michigan drivers driving without insurance, a car accident is likely to happen at any time. The Michigan Catastrophic Claims Association estimated approximately 15,000 claims. According to the Michigan Auto Law Attorneys, accident attorneys, there are 1 million drivers who are uninsured in Michigan. Our goal is to understand the complex injury and long-term. Our goal is to take care of the complex. This is written wrong. I'm sorry. In other words, we plan to take care of our long-term patients and our TBIs without raising the cost on insurance premiums. To that, we are going to delve deeper into what is going on with auto no fault. And for that reason, we bring in the Milliman Group. And I believe they're with us via Zoom, correct?
That's correct. This is Paul Anderson from Milliman.
Okay. So just like the neutral organization Fair Health, Milliman is an independent actuarial consultant firm. Its primary business includes consulting practices in employee benefits, healthcare, investments, life insurance, and financial services, and they also deal with property and casualty. The firm also provides data analysis, predictive analytics, and big data services. So here today with us is from Milliman is Paul Anderson, Principal and Consultant Actuary with Milliman Incorporated. Thank you for coming today. Please start. We're waiting for your presentation.
Very good. Well, thank you for that introduction. And you covered quite a bit of just my opening comments there. So I appreciate that. You made my work a little bit easier. I am attempting to share my screen. Can you all see that? Can you see my presentation on the screen? Okay, great. Okay. So this all came about somewhat last minute. I was contacted by one of Representative Carter's aides last week by Jonathan, and so I was able to send something to him yesterday. So hopefully you all received a copy of that. I don't intend to go through all the details in that. I included maybe more information than what I plan to cover, just so that you have something to take away with you. And if it sparks additional questions, certainly you can feel free to reach out to me, or you can just have that as a reference. So as it was mentioned, my name is Paul Anderson. I'm a Principal and Consulting Actuary with Milliman. I work out of our Milwaukee office, so just across Lake Michigan from you folks. And I appreciate the opportunity to speak with you. I very much would have liked to have been there in person. I kind of did the math, and it's about a 5-hour drive from where I am in southeast Wisconsin. And I just had enough other things going on. I couldn't kind of carve out whatever that would take, 24 or 36 hours to do that round trip there. But a little bit about, very briefly, my background. I started out at Allstate Insurance Company in the Chicago suburbs and was there for a little over 13 years before I joined Milliman. And I've been with Milliman for almost 17 years. So I hit 30 years in the industry this past summer. You know, I'm gonna, I think, spend about 15 to 20 minutes talking to you about what an actuary is and how that relates to auto no fault. But given my experience and the fact that I do this every day and I enjoy what I'm doing, I could certainly go on for quite a bit more than that. So feel free to interject with questions, or if you have questions at the end, I'll certainly leave some time for that. One other quick comment, I guess, here in the Milwaukee office, I lead our personal lines practice, which means I focus on auto and homeowners insurance, and a lot of our work relates to pricing and product development. So again, that relates specifically to the auto no-fault insurance, which is a particular challenge or a unique challenge in the state of Michigan there. But before I get into auto no-fault, Jonathan asked me just to kind of give some high-level perspectives on what an actuary is. So for those of you that are familiar with it, maybe bear with me. For those of you that are not familiar, I'll start with maybe some basic or high-level thoughts on it and dive into some of the details or some of the nuances that make an actuary unique. So really, at just kind of the foundational level, this is a really broad definition. I would say an actuary is a business professional with an in-depth knowledge of math, statistics, finance, and insurance. So that sounds maybe a little bit vague, but a couple things that I would point out. If you look at the in-depth knowledge, actuaries really dive deep in the subject matter that we study and that we learn. It is a highly technical and a highly analytical field, which I would guess many of you are aware of. And a typical actuary's knowledge in that material is very deep and very specific. However, at the same time of having in-depth knowledge, I would point out that there's also a fair bit of broad knowledge in that you can see I've identified several different topics or segments there, and we aren't just kind of a one-trick pony. We don't just focus on one or two topics. We have expertise in math and statistics. That's kind of our foundation, but we also learn a lot about financial matters and, of course, insurance. And once you get into insurance, that can also delve into policy language and contracts. And I'm not going to claim to be a lawyer, but it does get into at least understanding and being able to read and interpret some of the legal type contracts and policies there. So it is a unique combination of both in-depth and detailed knowledge as well as broad knowledge across these different topics. So within the United States, to officially be a practicing actuary, you need credentials from one of these two actuarial organizations. There's the Casualty Actuarial Society, or the CAS, and the Society of Actuaries, or the SOA. And again, kind of generically, the SOA deals with life insurance, health insurance, pensions, employee benefits, kind of everything that I don't do. So I'm on the property and casualty side. So the Casualty Actuarial Society deals with everything else. So all the property and casualty lines of business. I think because life insurance and health insurance, well, I think it covers, more companies or broader segments. It's been around for longer. The SOA is about, I think, 3 or 4 times the size of the CAS, because we do focus on kind of that niche of the property and casualty lines of business. In becoming a credentialed actuary, we take a series of exams. Oftentimes we'll compare it to a lawyer taking the bar exam or an accountant taking the CPA exams. But what's unique is that we have the exams are always kind of changing and being modernized and updated. But in generally, we have about 10 exams that we have to take and that we have to pass. Once you get about, 70% of the way through that, the first designation is that associateship that you see on the screen there. So that has different letters associated with it. And I would compare that loosely to like a master's degree in a higher level education. And that's after learning a lot of the foundational actuarial concepts that we need for our jobs. Then there are a few more exams that are higher level or more advanced topics in order to receive your fellowship. So if you went back to the opening, just the header slide, you would have seen after my name, some of the credentials there are FCAS. So that would indicate that I have passed all of the exams and I'm a fellow of the Casualty Actuarial Society. And again, I would compare that, again, kind of a loose comparison to a PhD as far as a higher level advanced degree there. That exam, that exam process is very rigorous. It can take, I would say, if you're going through them quickly, you could get through them in 4 or 5 years. It's not uncommon for it to take 9 or 10 or even 12 or 15 years. So the end result of that is that you have a well-educated expert in a lot of concepts. Really, it's touching on my initial comments about the in-depth as well as the broad subject matter expert there. So then, again, answering maybe the high-level question, what do actuaries do? Again, at a fairly painting with a broad brush, I would say that actuaries measure and manage risk. So again, I would kind of generally define risk, as you can see here, is the possibility of a range of future outcomes, some of which are bad, which in insurance, we would consider those to be claims or losses. So there is some likelihood that I or that each of you might be in a car accident, or there is some likelihood that maybe there's water damage in your home. And as an actuary, we would measure the likelihood of those different events, and then of course try and manage or mitigate that or to price for that appropriately. And I could certainly talk about that whole concept of evaluating and segmenting risk, in great detail there. So if you have any additional questions, I'd be happy to answer those. As far as what makes actuaries valuable, I touched a little bit on the first half, or the upper half of this slide here, is our subject matter expertise between the examination and the credentialing process, as well as just developing a broad knowledge. We bring a lot of expertise, a lot of skills, a lot of knowledge to the table that are unique. It's a very different skill set than sales, or than marketing, or distribution, or for handling claims. It is related to underwriting. Underwriting is also about differentiating risk, but this is, again, there's a little bit more specificity, granularity, or detail to that expertise. So we bring a great deal of subject matter expertise. And then I would say for the really good actuaries, you see the lower half of this slide here, where there's unique combinations of additional strengths or additional skills. Certainly our goal as actuaries is to kind of solve problems or to complete analyses. And again, as actuaries are able to kind of get out of their comfort zone or out of their number crunching world and actually interact with other business units or other entities and communicate effectively with them, that's really, I think, what sets apart a great actuary from a good or a really good actuary there, is if they see the broader picture, if that actuary in the pricing department can interact with claims or with sales or with marketing and kind of bridge that gap and speak their language and use or apply the analytical skills to other business units and work together to solve problems. And then it's also important to be able to do that, to be able to communicate that effectively. Obviously, we deal with not only numbers, which can be hard to put into words, but it's very technical concepts. My understanding is that you've had presentations from the Michigan Department of Insurance, or DIFS, and from the MCCA. And with MCCA and the no-fault reform and PIP coverage in Michigan, that very quickly gets very complicated. And actuaries certainly can get into the weeds on the numbers and the analysis, and to be able to communicate that effectively is not easy to do. And if an actuary can do that well, that really sets them apart. And even, it provides opportunities such as this, where, I, as a number cruncher, can interact with all of you as representatives of your constituents and of your state there. So I would say generally we live in kind of two different worlds, but it's important that I can communicate what I do and maybe the results of any analysis to you or to other people similar to you, so that you understand it, so that you can make appropriate decisions and discussions off of that. As far as where actuaries work, this is just a little bit of a diagram that shows really, again, we're not just pigeonholed into one role. Actuaries are used in a variety of different roles. You can see them listed here. Many of them are at insurance companies. Obviously, I'm at a consulting firm. There are a number of actuarial roles in government or pseudo-government type entities, and then what I would kind of generically call non-traditional roles that probably seems to exist for a lot of occupations and careers today. But again, you can see within insurance companies and consulting, there's different areas. I've kind of alluded to those or touched on those, whether it's life insurance or health insurance, or obviously I'm on the property and casualty space. So again, there's really a variety of organizations or potential roles where actuaries can reside or where they can serve and work. I won't go into all of these details, but again, to further expand on that concept, even within each of those organizations, there are a variety of roles that an actuary could play, or a variety of projects or assignments that we could take on. Here are some of them for an insurance company. Obviously, it's important that we help determine the right price for insurance. We may do different statistical analysis or predictive modeling. We help in developing new products. On the reserving side, we make sure that there's enough capital or enough surplus set aside to pay claims as they come due. And then experience studies, we may summarize or report on past experience. You'll see a similar list for consulting firms, but these are tailored to client-specific needs. So there certainly is some overlap. In a consulting firm, in a consulting role, really, we are often brought in to either fill a gap. If it's a small or medium-sized insurance company, they may not have an actuary on staff, or they may not have enough actuaries on staff to complete an assignment or to complete a project. So we may actually fill a void, or we may simply kind of add to the depth of their resources and provide kind of more bench strength and more resources for them to complete a project. There are some unique opportunities in consulting firms as compared to insurance companies where we get into things like mergers and acquisitions. I don't have it on this list, but there's opportunities for things like expert witness assignments, any opportunities where an insurance company or other entity may be looking for an outside independent perspective to either support them or to add insights or to help strengthen their case or to maybe offer a differing opinion on something. If that outside third-party view is needed, that's where a consulting actuary could come in handy. And then within the government and non-traditional roles, again, you may be familiar with some of this on the government side, given your roles on this committee. Each state regulates insurance independently of each other. I'm sure you all know that. So part of that process is to review and approve rate filings or form filings that are submitted. Anytime an insurance company makes a change, they need to submit that to the insurance department, and it needs to be reviewed and approved. And that differs from state to state what that process looks like, but that's a pretty critical role for actuaries within a government environment, is to make sure that what insurance companies are doing are A, that it complies with the law, and B, that it's reasonable and actuarially sound. Of course, I'm sure you've had a number of discussions around Public Act 21 that was passed in 2019. So that would be another opportunity for actuaries in a government role, is to really analyze, to review, evaluate, and understand the impact of any new legislation. The third item is certainly important. That's not my area of expertise, but topics like Social Security and Medicare, there's obviously a significant interaction with actuaries being in government roles, and just how they can offer their expertise to navigate those to those areas. Within education, that's another big opportunity for actuaries. You'll see actuaries at universities teaching, obviously in some of their different advanced degree programs and things like that. I won't go through all these. Another one that I thought was interesting, we are seeing more and more actuaries actually get hired by and brought into auto manufacturers. That sounds a little bit unique, but a lot of the large manufacturers like GM and Ford and even Tesla or Toyota, they, with all the new technology in cars, they are storing massive amounts of data. And that is now kind of a new asset for these auto manufacturers that they haven't had in the past, or at least not to the same degree. And that has value. So they are hiring actuaries to kind of navigate through that, to figure out what to do with that data, how to use it. And maybe it's another source of revenue or profit for some of these auto manufacturers, or it allows them to offer different services. So again, we're seeing some analytics opportunities actually with the household names like GM and Ford and Volvo and things like that. The other one thought I'd point out is the last one, I call it modeling vendors. The insurance industry uses a lot of third-party vendors or modeling firms. Some of them will model, natural disasters and catastrophe events, which is very useful for our insurance work. Others will model, I call it telematics data. If you're not familiar with that, that is using a lot of the technology either in cars or even in phones. It's the GPS technology. It uses things like gyroscopes and other technology that identifies how fast you're going, where you are, how hard you're braking, how hard you're cornering. All of that type of data and information is referred to as telematics. And again, maybe you're all aware of this through either your smartphone or through the technology in your cars, that's capturing massive amounts of data at 1-second intervals or 5-second intervals, and that can be stored and analyzed and evaluated to tell us about people's driving habits, or how much they drive, or where they drive, or when they drive. So actuaries can be used to assist in those types of roles as well. And then real quickly for imagery, if that's not evident, maybe where the link there is. It started with satellite imagery, but now with things like drones, we can get even more specific and more detailed. If we can take pictures or images of rooftops, or how close a house is to the coastline or to a river, or in a wildfire prone area, how close that house is to surrounding brush, that those images can be, again, converted into data and can be analyzed to make decisions related to risk and insurance. So probably the theme that you're seeing here is anytime there's kind of an opportunity for analytics, there is an opportunity for actuaries to step in, offer their services, and to bridge that gap between things like telematics or satellite imagery, and then this whole concept of insurance risk. So that's kind of a background on actuaries. Again, I could certainly go into additional details there. I tried to cover the high points there. Representative Carter gave a good introduction to Milliman. Just a couple high points that I would highlight. We celebrated our 75th anniversary last year. You can see we were founded in 1947 in Seattle, Washington. The name Milliman comes from one of our founding fathers. Wendell Milliman and Stuart Robertson were the two founding actuaries. We were Milliman and Robertson for a long time, and like many companies, they kind of simplify or shorten their names. So we are now Milliman. Our headquarters are still in Seattle. I think the gist of what I'm trying to show on this slide is really over the 75 years, we have expanded greatly our scope of services. The introductory comments, as well as this slide, highlight the different areas of services that we provide, whether it's the healthcare, life insurance, or P&C. The middle section kind of highlights that geographically we've expanded. We now have offices on every continent except for Antarctica. Again, really our clients or the people that we serve also spans a lot of different organizations and entities. One other item that we like to point out is on the far right there, the fact that we are independent. Milliman is not affiliated with or owned by an auditing firm or one of the big four accounting firms, or we're not affiliated with something like a reinsurance company. We are a standalone actuarial consulting firm, or actuarial and financial services, I guess I should say. And I guess because of that, we pride ourselves on the fact that we really focus on our clients and their needs and the issues or problems that they are trying to solve, which is why they reach out to us. So it's something that we think sets us apart a little bit, and allows us to, again, really focus on the task at hand or the issue at hand, rather than maybe some other potential opportunities or maybe even distractions there. This is just kind of putting that geographic footprint into an image, just to give you an idea. Probably about half of our offices are in the US, but we do have a presence around the entire world there. So now I want to spend a few minutes. I think I'm probably about out of time. I'll spend a few minutes just making the connection to no-fault insurance. And again, we could go on about this for quite a while here, but again, I'll try and cover some of the high topics, or the high-level topics. At the foundational level, as far as an actuary and our interaction with no-fault insurance, our primary objective is to really evaluate and to maintain the adequacy of the rates. One of our actuarial standards that is really critical and foundational to what we do is we are held to the fact that rates cannot be excessive, they can't be too high, they can't be inadequate, so they can't be too low, and they can't be unfairly discriminatory. By nature, as we evaluate risk and manage risk, what I defined as far as what an actuary does, that process of differentiating risk is essentially discrimination. And maybe that's a red flag word for some of you, but our intent is to do that fairly and certainly legally within the bounds of each state's laws related to insurance. The objective is to identify differences in risk and to separate or to differentiate the prices to correspond with that. Now, there may be reasons to mitigate that spread or to mitigate that difference. And there may be instances where we're going to charge different risks the same price, but by and large, I guess actuaries would say it doesn't make sense to charge a 16-year-old driver the same auto insurance rates as a 50-year-old driver. Those are very different risks with very different experience. And if a company did that, there's going to be another company out there that differentiates the risk, and they're going to write the better risks, and it becomes a troublesome situation there. So again, at the foundational level, we are trying to maintain the adequacy of those insurance rates, not only at the highest level, which would be for the entire state of Michigan, but then at a more granular level when you get down into individual risks. Again, I'm not sure your familiarity for each of you with an auto insurance policy. If you looked at your own policy, you would see different coverages on there. There are different coverages for either first-party losses or third-party losses. So whether you are at fault or whether the other driver is at fault. And there are also different coverages for injury-related payments or medical payments, as well as damage to physical property. So it's really that combination of first and third party injuries versus property damage that represents the major coverages on an insurance policy. Again, I know you're all familiar that Michigan is unique really from every other state in the country in the, I guess, the use of or the type of no-fault coverage or PIP coverage, which is personal injury protection, that is applicable in your state, in Michigan. So obviously PIP is a first-party coverage. It covers medical payments. I'm sure you're all familiar with that. What sets Michigan apart, up until 2019, you offered only unlimited coverage. So it was by far the most generous coverage in the entire country as far as the first-party medical payments goes. As you know, 2019, Senate Bill 1 or Public Act 21 allowed for the option to purchase some lower limits of coverage. Generally, I would say that giving options and choices for consumers is a good thing. It lets them match kind of the product, in this case, an insurance policy, to their needs and to their budget and things like that. But anyway, so that scenario of offering unlimited coverage has created some challenges, as you know, for the state of Michigan, which is what Public Act 21 has started to resolve. And I'm sure that's a topic of many of your discussions on the committee. But as actuaries, we do look at each of those coverages separately. Each of them, because of what they provide coverage for, each of them has unique issues. So we look at each coverage separately. Again, we start at kind of the highest level, which would be the overall state. And if we think that Michigan auto insurance for company ABC, if their rates in total need to go up 5%, that certainly is one objective. But then there's also the question, okay, how is a company going to do that? Are they going to differ that based on the geographic location or the territory within the state? Do the rates in Flint versus Grand Rapids versus Lansing, do they need to go up or down relative to each other? And then there's also additional allocation based on policy characteristics, driver characteristics, vehicle characteristics. If you have a safer car than I do, your rate should probably be lower than mine. If you have a newer car than I do, maybe your rate should be higher than mine. If you have no accidents or violations, and I've got 2 accidents in the last 2 years, I should probably have higher insurance rates than you. So there's assessing the overall rate adequacy, but then there's also the matter of allocating that down to very specific risk characteristics. And then I guess to summarize the kind of the process of what we do is we look at, we're trying to project costs into the future. So what we find the best way to do that is to look at historical experience and to project that out into the future. So we will determine what the ultimate amount of those historical claims will be, or what we think they will be. As you know, it takes a while for insurance claims to settle. Something like unlimited PIP coverage can take years and years to settle because of a lifetime injury or just a major injury. But we do try and project those to their ultimate amount. We also then we apply a trend for just changes in how often an accident occurs, the cost of those accidents, or just any trends in premium. If people are buying more or less coverage, depending on the situation, we want to reflect those trends in our calculations. And then, of course, there are just unusual situations, such as with COVID-19, everybody stopped driving for a period of time there, and suddenly there were a lot fewer cars on the road. Or on the homeowner side, where there's a particular issue, there can be severe weather that comes through, and maybe you have a particularly bad winter or particularly bad thunderstorm or tornado, or on the coast, you're dealing with hurricanes and different things like that. And what do you do with that extremely volatile experience? As actuaries, we have to consider that, we have to adjust for it, and assess that as we set the adequacy of rates. Just to give you a little glimpse of what that might look like, this is some industry data for PIP. This is on the left-hand side is the average frequency or the claim frequency. The blue line is Michigan. The dotted black line are other states that have PIP coverage. So that's probably 15 to 20 states underlying that line. But you can see in this case, this is claim frequency, so the number of accidents, and you can see kind of in the middle of the graph there is 2020, which is the impact of COVID. So the impact in Michigan, the frequency started out quite a bit lower, so it really didn't have that far to go down. But you can see there's a noticeable drop there due to COVID. And as actuaries, not only are we watching that, but then of course we're wondering, well, what's going to happen as we come out of COVID and as people start driving and returning to work? Is it going to go back to where it was in 2018 and 2019? Or, we've heard this for many, many different issues in society. What is the new normal after COVID? And you can see that in Michigan, it's actually remained quite low compared to kind of where it was at the peak of COVID or at the result of COVID. In other states, so that dotted black line, you can see that there actually was a little bit of a rebound, but it didn't go all the way back to where it started. So as an actuary, if we were looking at claim frequency back in 2019, and we were going to try and project into the future where we think the frequency would be, there's just uncertainty involved with that. There's no way we would have predicted something like COVID, and we would have estimated the frequency to be somewhere around 0.8, which obviously we would be wrong for every year after 2019 because of COVID and now this new norm that we're living in. So that's kind of just this gives you an idea of kind of what a trend analysis might look like and some of the considerations we have to deal with. On the right-hand side is the average severity or the average claim cost for PIP losses. Again, the blue line is Michigan, the dotted black line are other PIP states. And because of the richness or the generosity of Michigan's PIP coverage, you can see the average cost of PIP claims in Michigan is significantly higher than other PIP states, which is probably not a surprise. But here you can see, again, maybe this makes sense, that during COVID, it didn't really affect the average cost of claims. There's kind of a steady increasing trend all the way through mid-2021. And then, of course, that's where we start to see the effect of Public Act 21. With the impact of medical fee schedules, the opportunity to purchase lower limits, we're now seeing this, average loss of $70,000 start to decline to, it's settling down around $50,000. So as an actuary, again, we're trying to project, okay, what do we think the rates need to be in 2024? How in the world do we evaluate this curve? And we see these blips, these ups and downs and kind of roller coaster views here. And how do we project into the future? So this happens to be two unique situations. You've got a major legislative change and then a major pandemic that causes some disruptions in our trend curves. But these are examples of types of things that we would look at to try and evaluate trends and to make sure that rates are adequate in the future. And then one last thought, as far as tying it into no fault, I can certainly answer other questions on no fault, but certainly this is a bit of a unique situation in Michigan with Public Act 21, where that was a major change. But as an actuary, we certainly want to take that into account. So Public Act 21 changed the coverage. Instead of just unlimited, obviously there were opportunities for other limits. So as an actuary, we need to price how much should companies charge for those lower limits of coverage. For $500,000 of PIP coverage or $300,000 of PIP coverage, what should those rates be compared to unlimited PIP? There's also a change in benefits with the medical fee schedule, something that, I don't know, maybe if a procedure used to cost $500, now maybe it will cost $300 or $200. So, a claim payment in the future is going to look different than what it has in the past. So we need to, again, consider that and keep that in mind as we are setting the rates and projecting the rates into the future. So again, we consider all those things as we evaluate that overall impact in our projection of future costs and future premiums. We also, as actuaries, may want to look at the interaction with other risk characteristics. What types of customers are maybe more likely to buy a PIP limit rather than unlimited PIP? Is it, I don't know, a certain age group or a certain, a certain geographic location? That one sounds a little bit funny, but is there interaction with other risk characteristics that this legislation might impact differently in one group over another? And then we'd also want to consider the impact on other business units. How does this impact? You can see some of them listed here: claims or underwriting or marketing. So anytime there's something like Public Act 21, really that requires a whole separate standalone analysis to, to work with the lawyers or to work with other experts in interpreting the legislation, determining what does it impact, how does it impact it, and then of course the actuaries will do the quantitative analysis to actually implement or propose those changes in the insurance rates. So that's all I have for prepared comments, but again, I would be happy to answer any questions you have. Again, this is what I do every day. I certainly enjoy my job. Maybe one other quick comment, I guess. I've worked with Michigan for a number of years. I currently sign, so as an actuary, there are opportunities to sign off on financial statements for companies. I sign the statement of opinion, which is an actuarial term there, for Pioneer State Mutual Insurance Company, which is a Michigan domiciled, Michigan only company. Maybe some of you even have Pioneer State as your insurance company. So I work with them. I have had a number of other clients. I work with the MAIPF, which is the auto residual market for the state of Michigan. So I have quite a bit of experience, not only with auto insurance, but with Michigan. I actually enjoy some of the challenges that it brings, and certainly the opportunity to help companies navigate through some of those challenges in Michigan.
Okay, thank you, Paul, for this very informative presentation. We do have several questions, and we're going to get right to them. Representative Rogers.
Thank you, Chair. Paul, thank you for that last statement. I think you just said you signed a statement of opinion for Pioneer State and then MAIPF. Can you disclose for these graphs that you shared with us who is contracted with you for Michigan?
I can certainly disclose those that are that I'll say are public information, which are certainly the ones that I shared. We do work, or I work with a number of national or multi-state writers that would have exposures in Michigan. And I guess the nature of my work is it can be, I call them one-time projects. So they might ask us to do an analysis, and then when it's over, I may go a couple of years without working with that company. So I can certainly look back historically and tell you that, I've worked with Allstate, I've worked with State Farm, I've worked with Nationwide, a lot of the major players. I've worked with USAA. I'm saying that because I don't have any current assignments or projects with those companies that would impact the state of Michigan. But certainly have, maybe one other one. So when Public Act 21 was passed, State Auto Insurance Company asked Milliman to help them really implement the changes from that. So that's a little bit smaller, lesser known insurance company, but they didn't have the internal expertise related to Michigan and to PIP coverage and to some of those nuances. So a company like that reached out to help them actually implement the changes resulting from that legislative change. So those are, I guess, some thoughts related to some of the companies that would have exposure in Michigan.
Sure, thanks. But for these graphs that you provided us with, who contracted with you for those?
Oh, I'm sorry, yeah. So those graphs actually came from industry data. They call them statistical agencies. There's 2 or 3 organizations that aggregate data on behalf of the industry. And then those, in this case, 3 organizations kind of combined all of their data to provide really industry data. It probably spans about 80% of the industry. And we then purchase that from the organization. The common name, we call it fast track data. I think just because it's fairly readily available, I guess, and because it allows us to track industry trends and things like that. So if you're interested, the 3 stat agencies, it's called ISO, ISS, and NISS. Those are obviously acronyms for things, but again, those are insurance statistical agencies that compile data on behalf of the industry.
Thank you. And I'm going to ask you the same question I asked the last group that was before us a week ago. Sometimes when we look at these aggregated reports that you reference nationally, there's often an asterisk that Michigan cannot be fully analyzed. Do you have a comment on that because of the uniqueness of what we offer here?
Yeah, it's a good question, or certainly a valid question. If I was doing a multi-state analysis of PIP, so if I wanted to look at the 15 or 20 states that offer PIP coverage, I would certainly have to treat or handle the Michigan data very carefully because, you saw on the average claim cost, a Michigan PIP claim on average is $50,000, $60,000, $70,000 as compared to $10,000. So if, and I'm going to make up a silly example. So if we were looking at, let's say there were no 16 to 21-year-old drivers in Michigan, which is obviously ridiculous. But let's say Michigan was skewed towards older drivers, and then one of the less expensive PIP states had a bunch of young drivers. Well, if I was looking at the differences in PIP costs by age of driver, if Michigan is overrepresented in the older drivers, and I shouldn't say the good, but the less expensive PIP states are overrepresented in the younger drivers, that's going to make older drivers, because Michigan PIP is so much more expensive, that's going to make the older drivers look more expensive maybe than the younger drivers, which is may or may not be reasonable. So you have to make sure you understand, if you're analyzing PIP across multiple states, you don't necessarily have to exclude it, but you certainly need to know how it impacts and interacts your analysis, how it interacts with other states that might be included there.
Thank you. Representative McFall.
Thank you, Chair. This might be an odd question. I don't know. I'm new to insurance other than having it. So I have a question. I see adequacy, but I don't see accuracy. And the reason I'm asking is because like the Michigan Catastrophic Claims Association is sitting on $22 billion, but they're claiming that they have a $3.7 billion deficit. How accurate? Do you track accuracy?
I don't want this to sound like a cop-out answer, but I would almost argue that our accuracy is, and don't interpret this the wrong way, is 0%. I mean, if your insurance company charges you $1,000 for your auto insurance, what is the likelihood that your insurance costs during the next year are going to be $1,000? It's practically zero. I mean, it's probably, your insurance losses are going to be zero or something potentially quite large. So that's why, I mean, and you probably know this, insurance is really, it relies on the concept of the law of large numbers or of grouping risks together. So when you get into accuracy and precision, obviously we do that at a summarized level, whether it's by age or by zip code or by amount of coverage. Certainly our goal as an actuary is to align that as well as we can, or if you want to say as accurately as we can. So that will be at a summarized level depending on certain risk characteristics. In the specific example you shared about the MCCA, and for full disclosure, and maybe you know this, Milliman is the organization that evaluates the reserves of the MCCA. Those are some of my colleagues in another office. I do peer review that analysis, so maybe that's a good thing because I do have some inside information, not inside, but I have some in-depth knowledge of the MCCA and the reserving process there. When you say they're sitting on $20+ billion of money and yet they're running a deficit, as actuaries, we would say that the $20 billion of surplus that they're retaining is absolutely necessary to hold on to because they have tens of thousands of claims that they're responsible to pay for that could be paid out over 40, 50, 60, maybe 80 years. And they need to make sure that they have the money set aside to pay for that. In fact, if you've seen their report, that $20 billion is on a discounted basis. So it's allowing for investment income on that $20 billion of capital or reserves. I think the actual estimated amount of what those payments will be over the next 60, 80 years is actually in excess of $60 billion. So the MCCA is relying on a significant amount of investment income and a kind of this staggered payment of a lot of those claims in order to meet their obligations. So that $20 billion is really, it's a liability that they owe the insurance customers. If they could prepay all their medical bills, they would need to pay the $20 billion. So there's definitely, and I understand there's a balancing act there that, insurance companies have to set aside money because of their obligations to their customers. But then at the same time, from the outside perspective, it's like, man, they're sitting on this pile of money. And what are they doing with it? Or, is it necessary? And so that certainly that's also part of the government interaction or the government regulation process is to make sure that companies have enough capital set aside, but that they don't have too much set aside. So again, just like setting the rate level is a balancing act, even holding surplus in capital is also a bit of a balancing act.
Thank you. I appreciate that.
Thank you. Representative Stone.
Thank you, Madam Chair, and thank you for your testimony, Paul. I'm looking at the charts, and I was wondering if you could help answer some questions I have. So on the first chart, PIP claim frequency, Michigan seems to have considerably less claims. And I'm assuming it's not because we have fewer accidents and that we're not just safer drivers. What is causing people not to make claims? Do we have any insights to that?
I don't know that I have any good insights or definitive answers there. I guess some of it comes down to claimant behavior, or so just the response of the customer. Some of it may come down to obviously other insurance coverage that may be available now. So that would be health insurance, but I would imagine Michigan isn't that different than other states. In other words, people in Michigan would have access to health insurance just like people in Wisconsin would, or other states. I wonder if, because of the overall cost of auto insurance in Michigan and the fact that it's higher than most other states, I wonder if people are a little bit reluctant to file a claim because they are concerned that it will cause their rates to go up even higher. So that probably has some of the impact. I don't think it would justify or explain the fact that the frequencies are almost half of what we see in other states. Part of it could get into, when I say the demographics, it could be kind of the mix of urban versus rural. I don't know exactly what the Michigan distribution would look like, but I would imagine there's a pretty high concentration in the broader Detroit area. And the reason that's significant is that generally in urban areas, cars they physically can't go as fast as in rural areas because you're in congestion, you're in city streets and things like that. And if the cars are moving a little bit slower, those accidents tend to be less severe, which may be less likely to result in injuries. So that, again, that's a little bit of a hypothesis, but if Michigan is a little bit more skewed towards an urban versus a rural or suburban area, that could play into it. So I would have to maybe dig into that a little bit more, but those are a couple thoughts that come to mind, is maybe claimant behavior as well as things like just the mix of urban versus rural.
Thank you. I was thinking along the lines of claimant behavior as well, because if you've ever driven in Metro Detroit, we don't necessarily drive slower. On the second graph, the PIP average claim cost, is the difference between multi-state and Michigan because they have limited PIP claim accessibility, or is it is this attributed to catastrophic claims? Is this day-to-day claims? Is this just variable PIP amounts?
Yes, it is entirely driven by the amount of coverage that is offered. Most PIP states have limits of $5,000, $10,000, $25,000, maybe $50,000 of coverage. I think you would have trouble finding another state that even offers $100,000 of PIP coverage. So there isn't even the opportunity for a driver in another state to be anywhere close to $50,000 of payments or of losses, because they can't buy that much coverage. Typically, in other states, I think every PIP state or almost every PIP state also has bodily injury coverage, which is the third-party liability coverage. So if I were to cause an accident, my bodily injury coverage provides payment for the injuries to the other third party that's injured. So in no fault or in PIP states, they often still include bodily injury coverage, and there will typically be some kind of verbal or monetary threshold that allows the injured party to then, I'll say, tap into or to use their bodily injury coverage. So if if I'm in an accident with somebody else, well, so what that does, when there's some kind of threshold, especially when there's a low limit of PIP coverage, if there's only $10,000 or $20,000 of PIP coverage, once they've exhausted that, they then would have access to another coverage like BI that would allow them to recover payment for some of the additional injuries there. So if you compared the cost of BI coverage between Michigan and other PIP states, I haven't looked at it recently, but my best guess is that Michigan's BI coverage would be less expensive than the BI coverage in other states. So it's a little bit of where are the dollars going? How are they being allocated? So that's part of it. But again, in Michigan, up until 2019, injured parties, and I don't want to be crass about this, but they were basically given a blank check to cover their injuries. So if they needed lifetime attendant care, they had that coverage, and that's unheard of in almost any other product, much less auto insurance. So the unlimited catastrophic claims have a huge impact on these numbers.
Thank you for that. And I don't know, would it be possible to get the bodily injury coverage comparison between Michigan and multi-state?
Yes.
Thank you.
Thank you. And everyone, I know these are great questions, but unfortunately we have another presentation. So we're going to hear from Rep. Bazat will be our last question. And then Paul, if we need to forward additional questions to you, can we, or invite you back sometime in the future?
Absolutely. Either or both of those would be fine. Again, I enjoy talking about this and certainly sharing my knowledge. So I can, if there are immediate questions, you can certainly send those to me. If you'd like me to come back and either present something or just kind of come for a Q&A, I'd be happy to do that.
Wonderful. I think it's very important that we understand things like the law of large numbers and how risk is evaluated in zero-sum games in insurance. And our last question is going to come from Representative Bazat.
Thank you, Madam Chair. Real quick, didn't PIP claims go down because few people selected the unlimited coverage? And as I don't even know if you can answer my next question, but I got my insurance bill last night, and it went up $500. And I've been hearing since I've been in Lansing that we had to revamp this system because we were paying too much insurance. My insurance has gone up at least $250 per year since '01, and now it's gone up $500. But I guess my real question, it's a bad timing for you, by the way. I guess my question is that the PIP claims have gone down as well because of the unlimited selection by drivers, is correct?
Yes.
Can you answer that, or does that calculate into your numbers at all?
Yes. So the industry graph that I showed does, I think it certainly supports what you said, how the PIP costs are going down as drivers select options other than unlimited PIP. So they're selecting a lower limit, or the order of priority that you mentioned, or even things like medical fee schedules. I think one of the, at least to my knowledge, one of the areas that has impacted is actually on the MCCA. I think it's called the assessment, or an additional charge that is probably on each of your insurance bills. Because the impact of Public Act 21 did reduce the burden on the MCCA, and I'm not going to get the numbers exactly right, but if that fee used to be $200 every 6 months or every year, I think that came down quite a bit, so that it's under, well, when I say quite a bit, not compared to the numbers you just mentioned on your policy, but it came down, I think, to around $80. So it did, again, so that's really related to these catastrophic claims and the coverage above $500,000 or $600,000, which is where the legislation is going to have a big impact. So yes, there is some downward movement in the PIP specific coverage because of the legislation. I don't, obviously your specific policy, and I don't think you're asking for all the details there, but there are a lot of details that go into pricing your policy. including the company decision. The company that you are insured with, they may have different business reasons for some of their decisions, but if you happen to have, if you bought a new car or added a driver, obviously if you changed your exposure, that could change your premium. Or maybe if you, I won't assume this, if you had a speeding ticket or anything like that, any of those changes can certainly impact it. I will also say that for many years, so I'll say prior to 2021, the general trend was for collision and comprehensive coverages, which cover your vehicle, that those have been fairly favorable, because the industry, generally it's been favorable, so that there isn't a lot of pressure on those coverages. Those might even trickle down every now and then, and it's really the medical payments and coverages associated with that are driving insurance rates up. That has changed significantly in the last 2 years with the impact of inflation. Inflation is having a huge impact on parts and labor, which is now, some of the trends for collision and comprehensive, if those used to be, I don't know, low single digits, they're now well into the double digits. Again, I've been in the industry 30 years, and it's been a long time since I've seen anything like this. So if your collision premium is $400 and now it's going up to $600 or $800, that could be a huge driver of what you happen to see on your policy, is that combined impact of inflation. So again, with all the different coverages on your individual policy, there could be a lot of moving pieces that might be contributing to what you're observing. And I'm sorry to hear that. So.
Now, real quick, I haven't had a ticket since high school. Cops usually don't get tickets. My wife,
Keep it up. Keep it up.
I was in high school. But my wife has never gotten a ticket, no accidents. And we have AARP, and I thought they were supposed to be nice to old people, but apparently they're not. Thank you, Madam Chair.
You're welcome. Paul, Paul, before we let you go, I have a quick question, like a minute mystery. You were talking about the law of large numbers. I understand that concept. If you raise premiums, or if we change things where we reduce the population of people who are currently insured now under the reform, do you think if we reverse the reform that it would price people out of the insurance market? In other words, I had mentioned in my opening that there's about 1 million uninsured drivers in Michigan, and 40% of drivers in Detroit are currently uninsured. I know that there's some, because of the reform there with the graduated scale, that people are able to buy insurance now. And my question is, if that was reversed, or if premiums were raised to the point where it was no longer affordable for the people who could get that graduated scale, would that price the people out of the insurance market? Would it raise the number of people that we have who are currently uninsured?
I would, I want to say yes. I would imagine so, that if insurance as it stands today is unaffordable for 40% of the population in Detroit, and that goes up further, that certainly is not going to make it easier for the 40% to get insurance. So I guess, without getting too much into policies and things like that, obviously, I think there needs to be a balance between the coverage that's provided and, I would say really a range of coverages. So if you want to provide generous amounts of coverage, I think, a state, not just Michigan, but other states need to offer lesser amounts of coverage that are more affordable. That each state requires a minimum amount of coverage when you buy auto insurance, that those lower amounts of coverage need to be available, so that a broader portion of the population can afford insurance. So as far as the no-fault reform that occurred, I understand some of the things that you might be talking about, wanting to reverse or having a potential desire to consider reversing, maybe on some of the benefit side. That's understandable. Mm-hmm. I think that one of the good changes was to introduce other limits to PIP coverage. Mm-hmm. Unlimited PIP is just astronomically expensive. That there needs to be options that are, maybe it's $25,000, maybe it is $10,000 a PIP or $50,000 a PIP, where there's an entry point. I mean, if you think about what that's doing, that's covering your injuries in an accident. The likelihood of injuries being more than $20,000 is not that high. I know hospital bills can quickly get expensive, but the severe accidents are really quite rare. That, fender benders, if there is a need to see a chiropractor to take care of bumps and bruises and even a broken arm or something, that can probably be managed for $20,000 or $25,000. That's enough coverage for a vast majority of the accidents out there. And then we just need to really think about, okay, well, what happens in those exceptional or those catastrophic situations? How do we go about making those people whole? And that's maybe a different discussion, whether that's part of the auto insurance industry or is that health insurance or some other means there. But again, I think making sure that there is kind of a low level amount of coverage that's available, it can be a very effective way. So offering options for the customer to allow them to purchase something that fits their budget.
Thank you, Paul. I know we went well over our time, but this is very important. One of the things we mentioned on September 28th is this committee was going to do a deep dive and give each one of us the opportunity to understand the nuances of insurance. So when we make decisions up here, we're making informed decisions. I would like to invite you back because I'm sure there's more questions, so I'll have my team reach out to you about that.
That sounds great.
Thank you, Paul. Thank you for
time to Madam Chair. I thank you for your time and for all of the representatives on the committee there. I really appreciate it.
Thank you. Now we'll hear from the pharmacy benefit managers. We've heard from the plans, we've heard from pharma. Now here are the PBMs. So here today with us is Sean Stevenson, Director of State Affairs for the Pharmaceutical Care Management Association. Thank you for coming. Please come forward. The floor is yours.
Let's try that. Good morning, Madam Chair. I'm having a presentation pulled up right now, so thank you for your time this morning. Happy to be here. Sorry you're getting fill of Wisconsin folks today. The previous speaker from, no. You're getting your fill of people from Wisconsin. I'm from Sun Prairie, Wisconsin. Our biggest claim to fame is we have a corn festival, and it's our primary crop that we have there. That's the one, correct? But in addition to that, I'm also an avid Packers fan, and I know that you guys are 4-1. What's with the Boo Birds? And I will say this about you, Detroit fans: you travel well. Thursday night football, I've never seen so much blue and silver at Lambeau Field before, and that's a testament to your fan base. And you guys are whooping butt. I mean, you should be very happy and part of the Super Bowl conversation at the end of the day. So I'm just gonna go ahead and get started. Pull this up. And I know everyone's on a time clock here, so I'll try to be quick. So, good morning, Chairwoman Carter, members of the committee. My name is Sean Stevenson. I'm with the Pharmaceutical Care Management Association. It's great to be with you in Lansing today. I want to thank the members of the committee for the opportunity to present to you. I want to provide a very high level of introduction about what a PBM is, who we are, and how we fit in the pharmaceutical benefit ecosystem. If you don't know I'll say the word acronym PBM a lot, Pharmacy Benefit Manager. When my mom asked me what I do for a living, she says, "Is that the big peanut butter and jelly lobby?" And I said, "No, Pharmacy Benefit Manager's mom." So what's a PBM? PBM administers the drug portion of the health care plan. So if you all have your health insurance card. At the bottom, you're going to see your pharmacy benefit plan. That's who it's going to be at the end of the day, and that's where we come into play. So who are our members? So PCMA is the trade association for pharmacy benefit managers. Listed above are our members. We have 19. There are over 73 PBMs out there, so there's a robust availability of PBMs available to work with. But from our purpose of our association, we have about 19 members. PBMs administer prescription drug plans for more than 275 million Americans who have health insurance from a variety of sponsors, including commercial plans, health plans, self-insured employer plans, union plans, Medicare Part D, the Federal Employee Health Benefits Program, state government employee plans, managed Medicaid plans, and others. As I just stated before, there are more than 73 PBMs that work across the country, some of which specialize in certain states or regions, and some new companies are coming up every year. But while it's true that a PBM has a variety of tools to help moderate the increasing cost of drugs, hiring a PBM is not required. So who are our clients? As I just spoke of right here, you can see private sector employees, public sector employers, commercial health carriers, and union trust plans are our primary employees. If there's anything, I like rules of three. Like, if there's three things I want you to take away from today about PBMs, it's this. One, PBMs are the only entity in the drug supply chain dedicated to seeking lower costs. Two, no one is mandated to use a PBM at the end of the day. And three, PBMs account for 6 cents of the dollar spent on a prescription drug. And I have a graphic up here to show you where the other dollar goes. So, in the total dollar drug spend of a prescription drug, 65 cents goes to the manufacturer, 25 cents goes to the pharmacist, 6 cents to the PBM, and 4% to the wholesaler. So if the public policy objective is to lower costs of prescription drugs for your constituents, you really have to look at the whole dynamic of how a dollar is spent on a prescription drug at the end of the day. So what do PBMs do and don't do? One, we provide lower cost drugs for prescription, or lower cost for prescription drugs. PBMs administer the prescription drug portion of the healthcare benefit for employers and customers. And PBMs perform a variety of services to ensure high quality, cost efficient delivery of prescription drugs to consumers. First bullet on what we don't do. Number one, we do not set the list price of drugs. At the end of the day, that is not what we do. That is exclusively for the manufacturer to determine the list price of the drug. We won't allow you to take drugs that will be harmful or negatively interact with other drugs. And finally, we won't allow you to take a drug for the wrong reason. So some of the services we provide. PBMs are companies with unique expertise navigating the specialized field of prescription drug benefits and delivery. PBMs are proud of the work that they do to reduce prescription drugs, expand affordable access to medications, and improve patient outcomes. PBMs negotiate with drug companies to lower prescription drugs. PBMs work with pharmacies to create networks of pharmacies that provide the best value. PBMs facilitate home delivery of prescription drugs to patients safely and seamlessly. And PBMs help patients to stay on their prescription drugs to live healthier lives. PBMs advocate for patients in the fight to keep prescription drug access and affordable. Anecdotally, just when you would interact with a PBM yourself, when you go to the pharmacy, you pick up your prescription, and the pharmacist asks for your ID, they scan the back of it. In a matter of seconds, it's the PBM technology that processes your claim, makes sure that you are getting the correct prescription and the correct dosage and the correct quantity. In addition, PBM technology can check to see if there's a cheaper alternative, like a generic, to reduce costs and to ensure proper drug utilization. To achieve optimal PBM patient coordination, once a pharmacy enters a prescription in the system, it is electronically sent to the patient's PBM, checks with the pharmacy benefit to identify their benefits, and provide information like cost-sharing amounts as well as the patient's medication history for any errors or possible harmful, dangerous drug interactions. While pharmacies have records of prescriptions filled by them or a fellow chain pharmacy, they do not have records of prescriptions filled in other pharmacies. However, PBMs do, as long as the patient has used insurance. Given that information and the technology in real time and almost instantaneously, the PBM can determine if the prescribed drug should not be taken by that patient and can alert the pharmacist to any dangerous interactions before the patient pays any cost sharing and receives any medication. All this happens rapidly, seamlessly, and behind the scenes to improve patient safety and care. So one of the questions I often get is, how do we get compensated? It's some combination of the following ways. Spread pricing. So pharmacies charge different amounts of drugs. For example, pricing for a drug can vary based on whether a pharmacy is in or out of a consumer's network, or whether the pharmacy purchases more or less expensive versions of multi-source drugs. To manage these fluctuating costs, an employer or a health plan may ask its PBM to carry the risk that patients choose costlier pharmacies to fill their prescriptions, allowing the plan sponsor to pay a set reimbursement for each drug regardless of the pharmacy chosen. If what the pharmacy charges the PBM is more than the reimbursed rate agreed upon by the plan sponsor, PBM takes a loss. If the pharmacy charges less, the PBM earns a margin. Smaller employers often choose spread contracts because of the pricing predictability and savings they derive. Rebate retention. Employers and health plan sponsors may also choose to pay PBMs by asking them to retain a portion of the drug company's rebates, aligning incentives towards cost savings. This is a less common payment model among larger employers. Data shows that most rebates are passed through the PBM to the employer or her health plan sponsor 99.6% of the time in Medicare and 91% in the commercial market. Finally, an administrative fee. Plan sponsors may choose to pay the PBM a fee to administer the claim and pay the PBM whatever the pharmacy charges based on the contract between the pharmacy and the PBM. Many large employers prefer this compensation model over a spread model because they have the scale to absorb the variability. Plan sponsors may also choose to pay the admin fee for rebate administration in lieu of allowing the PBM to keep a small portion of the rebates to pay for those services. Looking at the drug supply chain, I'm going to go through two models, so just so there's a clear understanding of how we fit into the plan. So the physical drug model, so drug manufacturer makes it. That's going to be your Eli Lilly, your Pfizer, Moderna, et cetera. They're the drug manufacturers in that. Then there's they use delivery systems called wholesalers. They physically take the drugs from the manufacturer and get it to the pharmacist, who gets it to the patient at the end of the day. How it gets paid for. So plan sponsors pay for it. PBMs, if used, will work with the drug manufacturers to get rebate concessions from the drug manufacturers and work with the pharmacist to reduce a dispensing or come to agreed upon dispensing fee for the drug as well. And sometimes pharmacies use something called a PSAO. That's a Pharmacy Service Administrative Organization to work with the PBM. And at the end of the day, you know, the patient will have if there's a cost sharing involved, the patient will pay for that at the end of the day. So who's working to reduce costs, again, in this supply chain? It's not the drug manufacturer, it's not the wholesaler, it's not the pharmacist, but it's the PBM. Some notable metrics I just want to go through with you really quick. I'm a big believer in numbers and, you know, having big, bold numbers out there, it's easy to talk about. So 40%, $1,040 and $10 and 3/4. 40% first. PBMs help save patients and payers about 40 to 50% on their annual drug and related medical costs compared to what they would have without a PBM. $1,040. PBMs are projected to save employers, unions, and governments, programs, and consumers an average of $1,040 per person per year. $10. Payers and patients spend $1 on PBM services to save $10. And finally, 3/4. More than 275 million Americans receive benefits provided through PBMs. And I have the breakdown there from the Medicaid program, Medicare Part D, self-insured, and commercial health plans. Employers are overwhelmingly satisfied with their PBMs. I just want to speak on that just a little bit. As I stated, in fact, no one has to hire a PBM, but because plan sponsors are overwhelmingly satisfied with their service, they continue to hire them. In fact, the majority feel that the PBM contract is effective and transparent, with the vast majority reporting that we effectively reduce drug costs. Otherwise, they wouldn't use us at the end of the day. We're a business-to-business entity, and if we did not produce savings, our customers would simply find other channels to provide that benefit. PBMs create $145 billion in value to society annually. In a world without PBMs, if the people with their names on the doors in the Capitol here decided that, you know, we don't need a PBM, it would be about $58 billion lost savings annually. From our unique vantage point, sitting in between all the moving parts in the healthcare system, manufacturing, delivery, payments, PBMs are uniquely situated to have a holistic view on how subtle changes equate to big price tags in a world without PBMs. Finally, I have this last slide here. It's very specific to Michigan. So just to give you a couple of quick numbers, PBMs cover 9.2 million people in Michigan. We will save over the next 10 years $33.25 billion, and PBMs will save Michigan's and Medicaid $2.25 billion. So with that, I'll just conclude by saying thank you to the members of the committee for the opportunity to address you today. PCMA and the companies we represent are committed to working with all stakeholders to continue to improve the affordability of prescription drugs for patients. While I've spoken a lot about the work we do for those who provide health care coverage for consumers, the most important lens through which to judge these issues is not what is best for the benefit plan sponsor, the PBM, or the retail pharmacy, or the manufacturer. It should be down to what best serves the consumer at the end of the day. Through their work, PBMs are contributing to lower costs for health care coverage, lower costs, medications, and better and more affordable access for patients, which means more people getting their medications they need to lead healthier lives. Thank you again for the opportunity to speak, and I look forward to answering any questions you may have at this time.
Well, Sean, because we had such a long presentation before, we want to invite you back.
Sure.
We have time for one question, and it's going to be from Representative Grant. That's the one I saw raised her hand.
Good morning.
Thank you. I just want to make sure I have some clarification and give you an opportunity to respond to some of the concerns that constituents in my district have brought to me about PBMs. So I know when we talk about cost and you talk about the breakdown of what determines the cost of a medication, some would say that where we see the fluctuation, the most flexibility in cost, is at the point where a PBM enters the chat, so to say. So when you speak about your possible revenue streams, there's a lot of debate around rebates and how rebates actually do affect the cost of a medication. In your presentation, you said that PBMs retain a small portion of a rebate for general operating costs. I've heard some differing thoughts on that, so I wanted to give you an opportunity to respond.
And thank you, Representative Grant, for the question. So at the end of the day, our customers decide what they do with the rebates. It is not us. We are simply executing the play that they want to call. So what happens is PBMs get rebates from the drug manufacturers. Mm-hmm. And
who determines the amount of the rebate?
Sure, and that's negotiated between PBMs and the drug manufacturers, between those two.
Okay.
So they decide on a number at the end of the day. They're like, let's say it's $500, okay? So then me being the PBM, I go to my customer, which is, again, the employer that provides healthcare benefits to their employees, governments, federal governments, Taft-Hartley plans, whomever our customer is at the end of the day. We say, we have $500 in rebates. What would you like to do with that? And it is the employer's option or the government's option to decide we're going to do, what we want to do is we want to put that through to the point of sale for people at the end of the line. They can also say, we want to, you can keep a portion of it for payment of the PBM service. Or you can say, take that $500 and reduce my premiums for all my employees, which a lot of people choose to do at the end of the day. But to clarify, it is not the PBM that is deciding that issue. It's the person purchasing the PBM service.
Okay, and I know we're on a time, so just really quickly, on average, what percentage of the rebates do you all keep?
Rebate pass-through like I said, is 99% in the Medicare program, and in the commercial plans, it's 91%.
So do you have a number of what that revenue stream makes for you all annually?
No, I don't know what an aggregate number is. It's probably out there, but I'd be happy to find that and get back to you.
Okay, last question. Yeah. Are rebates more so linked to savings, or more so when someone is paying a rebate, would you say they're linking it to the savings for the consumer or the amount of sales for their product?
Yeah, great question, Representative Grant. Rebates are offered to incentivize favorable placement and formulary by the manufacturer.
So sales.
Yeah.
Okay, thank you.
Thank you.
Thank you, Sean. We're like everyone else. We're going to invite you back,
boy.
because
Look forward to it.
as we journey down this line of understanding the drug chain and how pricing is done. We'd love to have you back. We'd like to apologize or thank everyone who considered the fact that 4901 will be scheduled for a future meeting. We obviously ran out of time because of these great presentations. But thank you for understanding. We will be bringing 4901 forward. Okay, let's see. Okay, that's there and there. All right, we do not have any absent members today, correct? So, Representative, we need a motion to adjourn. Well, he was standing. We're adjourned.